Understanding Irrevocable Trusts, a comprehensive guide. What is an irrevocable trust? An irrevocable trust is a legal arrangement where the grantor transfers ownership of assets to a trust for the benefit of designated beneficiaries. Unlike a revocable trust, once an irrevocable trust is established, the grantor relinquishes all control over the assets and cannot modify, amend, or terminate the trust without the consent of the beneficiaries or a court order. This arrangement serves several key purposes, including reducing the grantor's taxable estate, protecting assets from creditors, and potentially qualifying for certain government benefits. Key features of irrevocable trusts. Permanent structure. Once established, irrevocable trusts cannot alter their terms or dissolve unless specific legal protocols are followed. Asset protection. Assets in an irrevocable trust are generally shielded from creditors and lawsuits, offering a layer of protection for the grantor's estate. Tax benefits. By transferring assets into an irrevocable trust, the grantor may decrease the value of their taxable estate, thus reducing potential estate taxes. Trustee role. The trustee manages the trust, handles distributions according to its terms, and ensures the trust operates in the best interests of the beneficiaries. How do irrevocable trusts work? The foundation of an irrevocable trust lies in the transfer of assets from the grantor to the trust. This transfer removes the assets from the grantor's taxable estate and may relieve them of tax liability on income generated by those assets. All types of assets can be placed in an irrevocable trust, including cash, investments, real estate, and life insurance policies. Practical uses of irrevocable trusts. Irrevocable trusts have a variety of applications in estate planning. 1. Estate tax mitigation. These trusts help reduce the gross value of an estate to minimize taxes. 2. Protection of beneficiaries. Grantors can set specific conditions for asset distribution, preventing mishandling by beneficiaries. 3. Income retention. Grantors can structure trusts to allow for the retention of income generated by assets, despite giving away the principal. 4. Special needs planning. Irrevocable trusts can help provide for individuals with special needs while ensuring they qualify for government benefits. 5. Qualifying for government assistance. These trusts can help deplete assets to qualify for aid, such as Medicaid. Types of irrevocable trusts. Irrevocable trusts can primarily be classified into two types. 1. Living trusts. Also known as inter vivos trusts, these are created during the grantor's lifetime. They can be funded with assets while the grantor is alive and allow more immediate access for beneficiaries. 2. Testamentary trusts. These trusts are established through a will and only become effective upon the grantor's death. Because they are created posthumously, they cannot be amended or revoked once the grantor passes away. Irrevocable trusts versus revocable trusts. Irrevocable trusts cannot be amended, permanently locks in terms and assets. Tax benefits. Assets are exempt from estate taxes, and income generated is not taxed to the grantor. Creditor protection. Assets in the trust are safe from lawsuits and creditors. Revocable trusts. Flexible management. Grantors can modify terms or revoke the trust as needed, as long as they are competent. Tax implications. Assets are included in the grantor's estate and are subject to tax upon death. Less protection. Since the grantor retains control over the assets, they are more vulnerable to legal actions. Recent legislative changes. The Secure Act. The Secure Act, enacted in late 2019, brought significant changes to retirement account distributions. Previously, non-spousal beneficiaries could stretch distributions over their lifetime. However, under the new rules, many beneficiaries must withdraw the entire balance within 10 years of the grantor's death. This change could impact the tax strategy for those using irrevocable trusts to manage retirement accounts. Conclusion. An irrevocable trust is a powerful estate planning tool that offers numerous benefits, including tax savings, asset protection, and controlled distributions to beneficiaries. Whether through a living or testamentary trust, it provides a permanent structure that can safeguard one's legacy. Individuals considering this avenue should always consult with a tax or estate planning attorney to navigate the complexities and ensure compliance with state laws. Irrevocable trusts represent an important component of comprehensive financial planning, suitable for individuals across all income levels. Understanding their intricacies could lead to significant benefits in wealth preservation and management.